Welcome to Emerging Markets, the Triumph of Hope over Experience, a webcast sponsored by Rayliant Global Advisors. I'm Laura Krieger. I'm the editor-in-chief of Edify, and I will be your moderator for today. I am really looking forward to today's conversation. We are going to get granular on emerging markets in a lot of different ways, including a closer look at a decision by the Colony Group, which is a over $19 billion in assets wealth advisor, their decision to become more targeted in their emerging market exposure by dedicating a sleeve of that exposure to a China equity specialist. We're going to also look at how China's economic ascension has resulted in rapid earnings growth for onshore listed companies. And we're going to dig into how investors can participate in that continued expansion. And we're also going to look at how novel aspects of China's markets, including regulations, state ownership, retail investor behavior, all of these can create significant alpha opportunities for investors. I have with me Jason Su. He's the founder, chairman, and CIO of Rayliant Global Advisors. Jason is also the co-founder of Research Affiliates, a smart beta and asset allocation leader. He's an adjunct professor of finance at UCLA Anderson School of Management and a visiting professor at Tsinghua University in China, Kyoto University in Japan, and National Chengchi University in Taiwan. We also have with us Philip Wool. He is the managing director and head of investment solutions for Rayliant Global Advisors. In this role, he conducts research in support of the Rayliant products with a focus on quantitative approaches to asset allocation, return predictability within asset classes, as well as the design of equity strategies tailored to emerging markets, including Chinese A shares. Last but not least, we have Jason Blackwell. He's the chief investment strategist and principal for the Colony Group. Jason is also the vice chairman of the Colony Investment Committee and a spokesperson for Colony Investment Management. Okay, so we're going to be digging deep into emerging markets in this broadcast. We're going to be spending a ton of time on China specifically, but before we get there, we're going to take a quick pulse check of our viewers' sense of where growth in the emerging market space is coming from. U.S. stocks grew their earnings per share at a rate of 6.7% per year over the last decade and a half. So how fast did earnings grow in emerging markets ex-China? Okay, y'all, what's the real answer?
Most people assume countries within the emerging market basket would generally produce high earnings per share growth, matching their GDP. That's in fact not the case, because when you invest in a country, you can't really buy the GDP. You actually invest in the companies who has to really grow their earnings, translate GDP into earnings growth over time. If you look at the slide, and this is in our forthcoming paper in the Journal of Portfolio Management, on average, what you see is the fantastic GDP growth does not translate for the average emerging market countries. In fact, when you X out China, the EPS growth is actually quite abysmal over time. China here is indeed the outlier. And so the actual question here is, what does it take for an economy to translate its GDP growth into corporate earnings growth over time? And what it takes is a vibrant PE and VC market, because you need that to incubate great entrepreneurs and their companies to a significant size so they can then go and list on the public market. And so oftentimes in most emerging markets, what you find is there just isn't that incubation, isn't that environment available. And so most firms are tiny. They're mom and pop, small size, brick and mortar economy firms. They never quite get large enough to list. And second, of course, you need a liquid stock market, making it worthwhile for someone to list their enterprise to get a higher valuation multiple to get liquidity. Again, that condition generally isn't available in most of the emerging markets, China again being that outlier. So I would say the big surprise is when you think of the multiplying effect of the corporate sector, multiplying the GDP growth over time, China is in fact quite unique and quite special as the one economy that does so. By and large, a lot of the LATAM, a lot of the Eastern European emerging economies, they tend to be much more commodity, much more secular. so they don't translate their GDP growth into corporate earnings growth.
There's another issue related to growth, and this is something that we didn't spend a lot of time talking about in the paper, but it's an issue that's critical if an investor has decided to allocate to China and they're thinking about how to do that. It turns out there are different ways to access China. So we have offshore listed companies. These are firms that list in Hong Kong, companies that list in the US as ADRs. And then you have, on the other hand, the A shares. These are companies that list on the mainland exchanges. And it turns out that if you peel back another layer, when you look at growth, what you find is that there's a big difference even within China at the growth of onshore versus offshore listed companies. And a lot of the companies that list offshore, these are the firms that you've probably heard of when you think of Chinese stocks: Alibaba, Meituan, Tencent. Those companies tend to list in Hong Kong or in the US as ADRs. They tend to grow a bit slower than companies that list onshore, which tend to be much earlier stage growth companies, companies that are growing because the Chinese economy is advancing and they're serving sort of domestic consumption. And so if you look at the onshore A shares, EPS growth over the last 15 years has been about 12.5% per year versus those offshore companies where you've got lots of state-owned financial firms, telcos that listed in Hong Kong. You've got sort of slower growth, mature stage tech companies that list in the US as ADRs. They've grown at about 5% per year over the last 15 years. And then if you kind of broaden that and look at emerging markets, but you strip out China, and this relates to that survey question, EMX China has grown at about 3% per annum in terms of corporate earnings. And so I think the perception that a lot of people have that emerging markets are just growing really quickly, and we see the GDP growth and we sort of extrapolate that to corporate earnings, which are what matter for shareholders. But it turns out that's not really the case, and that EM earnings growth is really being driven by China, and that within China, it's being driven by A shares. And this was one of the principal reasons that when we were launching a fund, we decided to focus on China A shares, because that's where we think you can capture the most of that growth.
So Jason, Jason Blackwell, actually, I want to bring you into this conversation because your firm recently made an allocation to China. You specifically did what Jason and Phil seem to be suggesting and kind of pulling China out of the broader EM exposure and investing directly in A shares, right, through the Rayliant Active China ETF. Can you walk us through that decision? Was your concern, was the motivating concern here, this growth issue that Jason and Phil are talking about?
And thanks for having me. One of the things that was really important to us was closing that linkage between earnings per share and GDP. It's been said by a lot of strategists over the years that you can't look at EM without China, and EM can't work without China. And in large part, that's true, but we think they were looking at the wrong parts of China and looking deeper into that A share market where we could get a little bit more of the innovation. We could get more of that small and mid-sized business in the A share. Gave us some real advantages from a return standpoint. You think about kind of broader global trends, and it's been very focused on growth and valuation improvements over the last several years. Going somewhere where we've seen the earnings per share, but not so much the valuation adjustment, made a lot of sense to us.
We're going to talk a little bit about how investors should be thinking about and conceiving risk when it comes to China, when it comes to emerging markets. So given the headlines that we're seeing around China, it seems like there's a new headline coming out, a negative headline coming out every week. There's the COVID lockdowns, there's the crackdown on tech companies, there's geopolitical tensions between China and Taiwan. I imagine that y'all are getting some tough questions about the decision to invest directly in China A shares, but obviously you are overcoming those doubts. So could you maybe speak a little bit to how you became comfortable to make this shift in your emerging markets exposure and take on that single country risk?
No, it's an important question. I'd love to say it was a really easy decision. It wasn't. We've spent the better part of 2 years looking at this kind of allocation. And we were doing it for both predominantly for long-term reasons, that we were again looking at the market and saying, we've got a really big exposure to China, whether we know it or not, whether we're actively allocating to it or not. Why shouldn't we be with a specialist in that space? And really taking a piece of the assets and saying, we're going to invest with someone that has boots on ground, that understands the Chinese market, made it a lot easier. We'll talk about sizing and the like, I think later in the presentation, but we're actually not even taking that significant of an active bet on the region. One thing that's kind of interesting from our perspective, we've never taken, outside of the US, a single country bet. We don't typically traffic in ETFs or funds that are country specific, again, outside the US. This was more of a China's too big to be wholly managed by a global emerging market manager, and that specialist was really important. The headline risk is certainly there. I only half jokingly say the last thing I do before I go to bed and the first thing I do when I wake up in the morning is check to see how the CSI 300 did and how our positions have done overnight. But where we were able to get comfortable, especially amongst those headlines, is we saw a lot of investors taking shortcuts on their homework, where they were saying China's uninvestable because they were looking at things like issues in the ADR market, or saying China's uninvestable because Russia's invading Ukraine and that's going to have some knock-on impact. And they're really easy storylines to put together for a quick, kind of soundbite on TV. But the more we did our homework, the more we said they're missing something. And in missing something, it's creating an opportunity for us. And so that really drove kind of the confidence to make the allocation that we did.
And so when you were considering different managers that were in the Chinese markets and ways of accessing the market, what was it about Rayliant that kind of stood out to you?
So I'd say a couple of things that we were looking for in the allocation. One, we talked to a lot of managers that were both Greater China or China A-share. The Greater China managers all told us they were planning on increasing their A-share exposure over the next several years. So why wait for them? Why be on the rising? Why not get there first? We also didn't want to take significant style exposure. We didn't want to get the China call right and then be overexposed on growth or overexposed on value and have that piece of the story fall apart. And then, and I think we talk a little bit about this later too, looking at the Chinese market is somewhat reminiscent of looking at the small and mid-cap market in the US 20 or 30 years ago, where there's a lot of data out there, but it's hard to consume. And that creates a lot of alpha opportunity. And so we wanted to be active in the space as well.
So Jason, Sue, you're actually dialing in from Taiwan right now. What are you hearing? And how does, how is Rayliant thinking about this question of China risk, especially when you start putting it into context of China's relationship with the U.S.?
And, Jason Blackwell mentioned it that, you don't go a day without really hearing some negativity about China. And that's got, a bit of a knock-on effect in terms of general global sentiment when it comes to investing in China. A lot of people want to sell a story of, China is like Russia, that the China-U.S. relationship will become the next Cold War 2.0. What I instead think a better analogy is the China-Japan relationship. I grew up during the era when Japan was emerging, and there's quite a bit of negativity because of that emergence of a second economic superpower. But if you think about that co-opetition relationship, of course there's going to be tension as two sort of economic superpower begin to sort of take market shares away from each other and begin to compete in the product space. But there's certainly a lot of collaboration, a lot of trading, a lot of business, such that the tension remains a tension, and it's often healthy because it creates competition. But because there's just so much trade going on, that tension never gets beyond being a tension. And of course, the rise of Japan, I think, was net great for the U.S., net great for global trading. So that's really the model, I think, that makes sense for a lot of people who want to understand what the future might hold. It's not a winners take all, right? You don't need to bet on, is it going to be U.S.? Is it going to be Japan? The same way today, is it going to be U.S.? Is it going to be China, right? What you have is you have a diversified portfolio because both models of growth are going to make sense, are going to work, right? U.S. is always going to be at the front of the innovation curve, pushing the boundary in business innovation in terms of technological innovation. China very much is going to be that fast follower with a large addressable market. They're going to sort of imitate and learn whatever the U.S. has discovered, quickly make it cheaper, make it more broadly available. And again, that big domestic market is really, really helpful as well. So you got sort of the two twin engines of growth available to you, accounting for much of the global GDP growth for probably the next 10, 20 years. And I think this is where you want to have both engines, right? You don't need to bet on one. And if you have both of them in your portfolio, they provide great diversification. As you see more and more decoupling, that's actually a good thing for you. And over a long time, you're going to be happy having both. You don't need to bet on one versus the other, right? That's not the right way to think about it, right? The free lunch is diversification. You want to get that free lunch.
It makes sense. Phil, did you want to add anything to what Jason's saying?
What Jason's talking about with spreading your bets, I mean, this is diversification. And another issue that we've written a lot about is misperceptions about where diversification comes from within emerging markets. And for investors who use a global emerging markets manager, how diversifying is that exposure really? And this correlation matrix shows that if you look at US stocks versus EM, which includes China, the correlation is 0.75. That's not terrible, but it's probably not as much diversification benefit as most investors imagine that they're getting when they invest in EM. Of course, that's one of the promises of emerging markets. Now, when you look at China, and this has to do with some of the things Jason was mentioning, the fact that China and the US are in a competition with one another. It has to do with China's different policy environment, the fact that there are lots of retail traders in China that influence the market, and that's something that we will certainly hope to discuss later on. These features result in lower correlation. So if you look at the A shares, correlation with US stocks is about 0.38, so much lower than broader EM. And then interestingly, what our research shows, and this is something that's relevant to investors who imagine that they can get exposure to China through Hong Kong listings or through US ADRs, which might seem safer, although they have a host of their own risks. The correlation is actually higher with global markets. So correlation between US stocks and offshore China is 0.65. So significantly, or 0.58, I'm sorry, which is much higher than what you observe with A shares versus the US. If we can go to the next slide, very often these diversification benefits are sort of working in abstract space and sort of, thinking about portfolio theory. But this year they've been on full display, particularly in the second quarter. You had the situation where the Fed was really leaning into rate hikes and tightening, and US stocks were tanking. And at the same time, China, which had sold off a few months earlier, was actually coming out of lockdowns. The monetary environment was easing, lots of talk about stimulus and policy support for mainland listed companies. And so Chinese stocks, particularly the A shares, were literally moving in the opposite direction of US shares. And so this is the type of diversification, again, as Jason Su said, spreading your bets and taking advantage of the fact that these markets, even though China is really integrated in the global economy, financially, the markets aren't quite as integrated. So there's a big opportunity for investors. And once again, this is exactly why, in terms of creating an active exposure, we favor the A shares, because they really have that benefit on the beta side that they're just much less correlated than a lot of the other ways that people access emerging markets and even Chinese offshore shares.
Great. Let me actually ask this question of you, Jason Blackball. Do you feel like China, in your view, Is it a tactical opportunity for you, or is it a strategic allocation for you and your firm?
Yes, is the answer.
I like that.
I think it's actually a rather important question. We were looking at the short run and saying, okay, there's a lot of bad news out there, right? There's potentially a fear premium out there that we can harvest. But there are a lot of potential catalysts that kind of turn that around over the short run, whether that is, we haven't seen a full reversal of the zero COVID policy, but we've seen some tweaks around the edges that are not shutting down cities at the same rate that they were before. We were looking at very bearish sentiment on Wall Street in terms of China, and that sentiment has softened, and we're starting to see some flows. And then third, and I think this is perhaps underappreciated, you have a National Party Congress coming up, and a lot of research suggests that stocks do pretty well in the year or two after the National Party Congress. And so we see a lot of short-term catalysts that potentially moved up our trade a little bit faster than we otherwise might have. But the longer-term element is absolutely there. At Colony, we don't invest in things dynamically that we don't want to be in long term. It's just not part of our ethos. We look for opportunistic times to add to positions or enter positions, but we tend to do it with a long time horizon. We'll talk a little bit about index inclusion. We think we're ahead of the game there. Thinking about I mentioned looking at all the other active managers and how they were all telling us they were planning on increasing their A-share exposure. We wanted to be ahead of that. And then finally, there is this element of, even if GDP growth is potentially softening in China over the long run, that doesn't necessarily mean that the earnings per share growth also slows. And we think there's tremendous opportunity to invest in operating businesses.
From a portfolio perspective, we've talked a little bit about some of the, some of the different influences that are impacting the Chinese market. Where are you seeing opportunities in China right now?
Yeah, so I think one area, and this gets to something that Jason B. said about not wanting to have too much style exposure. One of the mistakes that we find a lot of investors make when they pursue investing in China is that they think that they have to invest in high-tech companies. And so they gravitate toward the offshore listings, the ADRs that have experienced a pretty rough run over the last year and a half. But they don't realize that you don't need to pursue the same type of growth strategy that you would in the US to access China's growth. In fact, the growth in China is really broad-based. In the mainland market, it's spread pretty well across sectors, so you don't need to have sector exposure to high tech. And in fact, tech stocks make up a small part, less than 15% of the index when you're looking at the A shares. And it turns out there are a lot of really rapid growth companies that are hiding out in what I would regard as really boring industries, industries that just don't catch the attention of retail investors. So a better way to invest in EV than buying Tesla would be to go for companies that are manufacturing materials that go into EV batteries. So there are companies that mine and process lithium that have seen really amazing growth over the last year. And these stocks are just generally overlooked by retail investors. There are companies in the semiconductor space in China, and this gets to Jason Su's point about competition, technological competition between the US and China. China right now is pushing lots of subsidy support to the semiconductor industry domestically. And again, if you look at companies that are sort of flying under the retail radar, companies that are in boring parts of the chip space, there are plenty of opportunities. And these are stocks that are also not really subject to bidding by institutional investors, because institutions still make up such a small part of China's mainland market. So those are the sorts of places within the ETF that we look. And of course, as I said, it's a really diversified approach. And so it goes beyond tech, but I think those are particularly interesting areas now.
Excellent. Okay. Here's the next poll question. At the end of June China's mainland equity market was the second biggest on the planet behind the US, had a market cap of around 13 trillion in US dollars. So what percentage of the MSCI's market cap weighted global equity portfolio, the MSCI ACWI, what percentage of that is invested in Chinese A shares? Is it 10%? Is it 5%? Is it 2%? Or is it less than 1%? Let's dive into this a little bit further. Phil, how on target were we?
Yeah, so 16% of people pick less than 1%. And in fact, the weight of A shares in MSCI ACWI is about 0.7% today. But there's nothing wrong with this notion that China should make up a bigger part of the index. The fact that it makes up a small part of global benchmarks is really it's a legacy to the time when A shares were hard to access. It was hard to invest in onshore Chinese companies. Today, that's really easy. Our ETF invests in A shares, and you can buy that in the U.S. And so I think just to sort of put this underallocation that investors have to China and to China A particularly in a perspective, you can look at the biggest allocation within ACWI. The biggest single stock is Apple. It makes up about 4% of the weight of the index. Last year, Apple sold about $70 billion worth of goods and services to Chinese consumers. And yet Apple at 4% of the benchmark makes up more than 5 times the weight of China A shares, the whole market combined. So less than 1%, for us, that's an opportunity, again, as Jason Blackwell said, to get ahead of these future flows into A shares. And this is another reason that we chose China A as the focus for our ETF.
What we're talking about here is kind of in contrast to the 30% that your firm puts into emerging markets exposure and that you carved out to dedicate to A shares, active A shares. So I think this might be a question that a lot of advisors would have as they're thinking about how to invest in China in its own bucket. How big should that bucket be? How big should they be? How much should they be allocating? And maybe you can explain a little bit about how you arrived at your own number.
No, and we need to do a little bit of mental acrobatics to get to our number. I'll clarify just in case anybody thinks we're that far out there. We didn't do 30% of our equity exposure to China. We did 30% of the emerging market exposure. And so for most client portfolios, it actually works out to be 1% to 2%. So it's not a huge overweight relative to the global market cap weights, but it is meaningful. And the way we got there is we were looking at our global emerging market manager, and they were underweight. They were underweight China. They were following a lot of the same kind of headline risk. They were also a bit more restricted to the offshore market, and so they were much more in the ADR space. And we said we want to get to something that approximates what an uncapped emerging market weight to China looks like. And the way to get there is to carve out about 30% of the EM and give that to a specialist. It's one of those allocations as well where we think there's a tremendous amount of alpha opportunity with a relatively small allocation. And so, with a 1-2% position, that oftentimes doesn't move the needle on total portfolio performance. Our view was we could do a 1-2, even 3% position, not introduce a whole lot of downside risk, but actually potentially meaningfully add to client results.
Okay, so something we haven't talked much about yet is this question of passive management versus active management. So I'm going to advance the slides here. We're going to talk a little bit about why active is a good approach in the Chinese market and in emerging markets in general. So let's drill into this. The Rayliant Quantamental China Equity ETF, that's the ticker RACI. It's the world's first active China A shares ETF. So Jason, Sue, why go active in the China A shares market? What's the appeal here?
Laura, normally if you talk to me about investing, I would be a big proponent of going passive, going cheap, because we know, according to research, when you look at most markets, certainly when you look at the U.S., when you look at equity more broadly, it's really, really hard for a active manager net of fee to certainly outperform consistently. Now, obviously, that's because markets are efficient in markets like the U.S., and alpha is a zero-sum game, right? So if it's just really intelligent trained professionals trading, it's hard for consistent alpha. But when you look at China, China is 85% retail traded. So if you look at the slide on your screen, that's what the Chinese A-shares market is like. It's a lot of social gambling, meaning there's a large reservoir of willing losers and consistent losers. And because they save so much money, they continue to come back into the stock market, providing that sort of willing, negative alpha liquidity, that reservoir. So when you look at the numbers, average Chinese active managers, Chinese active mutual funds do outperform consistently. And again, you shouldn't be surprised when you think about the mathematics of alpha, right? Alpha is a zero-sum game. When that market's 85% sort of social gambling, inexperienced retail investing, being a disciplined active manager gives you a real edge and allows you to outperform consistently. So really, when I think about going active versus passive, that choice is really predicated on are you dealing with an inefficient market, and Chinese A-shares market is, at least at this point in time, very inefficient. Now, a lot of people ask, well, is that market going to become efficient very quickly? So might there be sort of too little time to squeeze out some alpha? This is where, again, looking at data and looking at markets like Japan, like Taiwan, like South Korea, that sort of are a few decades ahead of China. Today South Korea is about 50% retail traded. Taiwan's about 60% retail traded, even though they've been included in MSCI as a very meaningful component for about 20, 30 years. What it tells you is there's something that's cultural about Asian stock markets, that retail participation generally remains high, even after major inclusions, even after being promoted as a sort of developed economies. And we expect that to be a case for China. And then the speed at which China becomes less retail is probably going to be even slower just because of the size of it. So going active in China makes sense. The data supports it, the theory supports it, but certainly you want to pay attention to the change in retail participation over time.
Now, I think, Phil, you wanted to add something about the value here of active management in understanding local markets, right?
Yeah, because I think this is another area, and Jason Blackwell touched on this, where the approach that Rayliant takes is a little bit different. So China's market, as Jason Su just said, is very inefficient because you've got lots of retail investors and they're trading on animal spirits. They're not doing fundamental analysis. So you could take traditional methods for investing in stocks, scoring companies, whether it's fundamental research or quantitative methods, and you could apply that in China, in the mainland market, and it's going to do well because the market is so inefficient. But what we've found in our research is that going beyond that, so taking all of the traditional stuff and then supplementing that with local data, and importantly with local experience. So Rayliant and the team have been in China designing quantitative strategies since 2009. We have a team in China now in Hangzhou. Their job is really uncovering local data sets, figuring out how to make sense of the local data in a local context to score stocks with these local inefficiencies in mind. So looking at things like differences in accounting standards, differences in regulation, the fact that 50% of the benchmark in China is state-owned, and some of those are really good companies, and some of them are value traps. And so being good at applying that kind of local knowledge and experience to scoring stocks in China is really important. Things that we look at. So it turns out, there's another misperception that people have about China, that maybe the data are hard to come by or the accounting is super opaque. But it turns out for data-driven investors, this is really a playground, and it's an amazing place where we can get data, for example, on the political connections of companies, managers, and directors, and evaluate, does that confer benefits on shareholders? Is that a way for politically connected people to siphon money away from shareholders and companies? looking deep into the financial statement. So finding banks that have rainy day reserves that are being undervalued by the market. And if you scrutinize their footnotes, you'll find the data there because Chinese accounting standards have a lot of requirements that we don't have under GAAP. And so the point is that there is lots of interesting data. If you understand China, you can make sense of it. And as a result, you have an even greater edge against retail investors. And so I think that sort of local aspect to what we do with RayC is really important to our approach to active management.
That's really interesting. Can you give like maybe some examples of local data sets that you're using in your analysis?
Yeah, so another data set that's fascinating, and it's probably unfamiliar to anyone investing outside of China, is data on what retail investors are buying and selling. So this is sort of like, think about it like getting to see the order flow of Reddit traders on Robinhood. And so in China, we can get access to the data. And of course, explicitly putting ourselves on the other side of retail investors' trades, that's what we're setting out to do. But even more interesting is we can get data on individual traders that have very large accounts. So there are small retail investors. There are also very large retail investors. So one of the things we're looking at is large retail investors who suddenly make a big trade in a specific stock. And what we find is that it actually makes sense to piggyback on their trades. Often these are informed individuals. And so they've got some information that wouldn't show up in the financial statements. It's not going to show up in any other market data. But because these data are abundant in China, we can access those. So that's the type of thing that, I think as systematic investors, we're really happy to get our hands on data like that and to use that to improve the scoring of stocks within the ETF.
Yeah, and I'll add on, Phil talked about, state-owned enterprises. I think that's another great example of where a lot of investors just haven't done their homework on it, and you start to peel the onion, and the headline isn't as is actually probably more informative than you think. We were really moved by some data that Jason and Phil put together that showed it matters what level of political connection is involved in the state-owned enterprise. And, a lot of ETF providers or managers will just have a blanket, no state-owned enterprise in the portfolio. But Phil, it may make sense to talk a little bit about what that research shows, that not all of them are bad, and in some of them it's actually a pretty good sign.
Right. It's a great point. And this is, as I said, it's a big part of the market in China. And, our instinct was, because state-owned companies are heavily discounted by not just foreign professional investors, but even local retail investors, they sort of mistrust the state, and rightly so. And so they paint all SOEs with the same brush, and they apply big discounts. So if you were to pursue a value strategy in China, you would probably end up with a portfolio that was just full of SOEs. They always look like cheap stocks. What we recognized is that some of them are actual bargains because they're really efficiently run. They actually get benefits from subsidies and other state policy support. And so the trick is then, how do you pick out the good state-owned companies that are trading at a massive discount? And as Jason B. said, part of it is looking at political connections. And in fact, what we find is that the centrally controlled SOEs with national level directors or managers, they're actually in the spotlight. They don't want to make mistakes or do anything scandalous because it reflects really poorly on the state. And on top of that, very often when policy support is coming to companies' way, Beijing will just send in the A team and put the most connected people in charge of the company. So that can be important data when you're trying to weed out the good and bad SOEs. Looking for other things, like I said, where is subsidy revenue coming from? That can be a risk because if it gets shut off, suddenly a company's earnings can implode. But in some sectors, that can be a huge tailwind. And so certainly our models are processing data to try to tease apart those nuances in SOEs that a lot of investors who don't have the local expertise are just going to ignore.
So Jason Blackwell, let me ask you this. Is this kind of hitting at the reason why Colony chose an active exposure towards the China ETF space? Because, a lot of China ETFs out there are passive funds, and they tend to be, if they're not broad funds, there's a lot of them out there that are very thematic in the targeting the Chinese growth equity space. So is that the kind of the stuff that we're talking about here? Is this why you opted for the active exposure?
It is, and I go back to what we were talking about earlier, that we didn't want to take a huge style bet. We didn't want to get the theme wrong, but get China right, and have that hurt us. We also didn't feel like we needed to. We didn't feel like we needed to take a real active decision on China by getting really focused in on just the technology sector or just the value exposures, et cetera. But we also looked at this market and said, this reminds us of that small and mid cap space 20 and 30 years ago in the US, where there's reasonable ability to pick up some significant alpha without potentially blowing up the beta exposure. And so we like that kind of core alpha approach where we can take advantage of some of these opportunities. But overall, what we're still getting is the general exposure of the market.
Makes sense. Want to put a plug in for Jason's newsletter on LinkedIn. It's called The Bridge. You can just get a download on the regular basis for his viewpoints on China and emerging markets. All you got to do is just follow The Bridge on LinkedIn and get that there. So a lot of great questions come in. We have a lot of questions to get through today. So if we don't get to yours, don't worry. Someone from Rayliant is going to get back to you personally. I'm going to start with this question here. This is for Jason, Sue. So we've seen a lot of headlines over the past 6 to 12 months about Beijing's crackdown on big tech. And I wanted to ask you if you thought that this crackdown has finished. And if so, what does that mean for the Chinese growth equity space?
So, Laura, I think to sort of properly frame it, you don't want to think of this as sort of Beijing cracking down on tech broadly, because Beijing is actually quite supportive of a lot of, say, manufacturing type tech. Beijing specifically went after what I would call consumer tech, especially consumer tech that are listed in the U.S. And the concern there is, look, most of these consumer tech firms are big data companies. They have detailed records of transactions, whereabouts, habits, financial information of Chinese consumers. And many of them have many hundreds of millions of sort of detailed information about Chinese citizens. Now, once that consumer tech company lists in the U.S., does the data then belong to, say, American investors who become perhaps the dominant investor in, say, an Alibaba, right, in the Tencent? So that was what Beijing was really concerned about, which is, without proper understanding of who owns the data, who has the right to sort of dig in and understand the sort of intricate details of Chinese citizens, once a company lists in the U.S. And so there was sort of a strict regulation with regard to sort of listing in the U.S. and what they have to comply. And of course, that spilled over to also the U.S. SEC being quite unfriendly to Chinese companies listing in the U.S. as well. So it's kind of cracking down from both sides. So yes, a lot of that is behind us. From the China side, I think Beijing is a little bit more comfortable with what it means to have a Chinese company be listed in the U.S. and the protection of the underlying data. But the risk, I think, remains in terms of, are the SEC going to be happy with the degrees of transparency and disclosure from Chinese companies listing in the U.S., so these Chinese ADRs. And if you look beyond sort of just, the regulators, the tech firms in China today face an additional challenge. So, when you're too tech concentrated, what you see is they have the same issue with the American tech firms, is that the valuation multiple tends to be more stretched. And the underlying assumption about rapid fundamental growth from consumers, that assumption is probably a little too optimistic. It's true for U.S., true for Chinese assumption as well. So my conclusion there is, so some of that uncertainty, some of that political risk is behind us. But if you're looking to access China in terms of just a pure tech play, you got to worry about some of the fundamental issues in terms of consumption growth coming from these consumer techs.
Okay, so we have a question here. You have we've been talking about two ETFs, Ray-C and Ray-E. Can we just compare the two ETFs? What's the difference and similarities there?
Well, I'll take a crack. Ray C is Rayliant China, and Ray E is Rayliant Emerging Markets. Now, clearly, our deep China expertise comes into play for both because within the emerging market basket, China is nearly 50% of EM. Right, this is something that Jason Blackwell noted. Right, like you can't buy EM without having China be sort of the dominant driver of the return and risk. So really, at the end of the day, it's about getting a really deeply expert active manager to manage your emerging market exposure because the China component is really, really large. So again, for us, the RAE is meant to outperform MSCI Emerging Market Index, and RAE C is sort of that carve out, right? If you're looking to overweight China, Ray C would be a great satellite complement if you already have meaningful commitment to the EM exposure.
Okay, I've got a question here about central banks. How aggressive do you think the central bank will be in restarting the Chinese economy after everything that we've seen with COVID lockdowns and so
on? When you look at stimulating the economy, Beijing takes a slightly different approach than most of the Western economies, right? The Western economies, it's been a very blunt approach where you QE, right? You just inject liquidity into the capital market and sort of let the capital market decide where that liquidity goes toward. China tends to be a bit more targeted. So what you see is they use a much more aggressive mixture of both quantitative easing, so through the monetary channel, but then a really targeted sort of fiscal stimulus in terms of government spending. So what we expect, and this is true generally coming out of the Party Congress year, and especially in years where GDP is weak, Beijing goes through a very standard playbook. They're going to gradually ratchet down rates to make sure that cost of capital is low. They're going to make plenty of liquidity available for the big state-owned bank to borrow and then lend out to the rest of the economy. But then they will complement that with very, very aggressive government spending. And we saw that during the global financial crisis. Beijing spent, very significant portion of their GDP in terms of sort of targeted government spending in key sectors. And Phil already mentioned it's going to be primarily in the brick and mortar part of the economy. So very much a lot of the manufacturing, a lot of the sort of consumer staples, consumer cyclicals, all of which are going to benefit from massive government stimulus.
Phil, Jason, did you want to add in anything on that, over top that?
Yeah, I mean, I guess I would add just in terms of the timing of the stimulus, I think one of the things that led to the delay in China easing on the monetary side, pledging to directly stimulate companies in the brick and mortar economy, as Jason suggested just a second ago, was really the COVID situation and the fact that if you've got a quarter of the country's population locked down, that's both consumers and its workers at factories. It doesn't really make much sense, and it won't do any good to enact stimulus because you can't force people to spend if they can't leave their house, and companies can't really invest if the factories shut down. And so I think a big part of the timing was just waiting for zero COVID, which it's in many ways it's a terrible policy, but it can be effective in the short run. And so they were waiting for the economy to sort of come back online so the stimulus could take effect. And I think sort of on the topic of COVID policy, this is something that Jason Blackwell mentioned before the National Congress, which is happening in a couple months. And this is one opportunity for a policy reset. So China doesn't want to make any huge shifts in policy leading up to this, what's sort of for them an election year. But we can expect at the National Congress, China might really soften the COVID policy and sort of transition to a new phase that's much more growth oriented. And so as you're trying to process the stimulus path that China's taken, there's some logic to how they've chosen to stage things.
And I'll just add from an allocator perspective, the way we look at this, I mean, it's fascinating to be having a conversation about stimulus, easing of central bank policy, et cetera, given, what we're seeing around the rest of the globe. China has this benefit of a lot of levers that they can pull and pull fairly responsibly to stimulate growth, whether that's on the COVID policy side, it's on other political policy side, fiscal or monetary. They just have a lot of room that they can move, and they don't need to be super aggressive in doing so in building some white space between them and other global markets.
All right, so one last quick question here, and that is how much, in 30 seconds or less, how much should investors be concerned about China's property market troubles?
So, every 2 years, the world sort of prognosticate about the expensive property market in China, imploding and will drag China down much as the real estate bubble dragged down Japan. And, that happens every 2 years, and it hasn't really blown up yet. And really what you want to think about is, yes, Chinese people invest in property market, but they invested in it not like how Westerners do, right? Like they're not buying it for income generating purposes. They're buying it like they're buying gold, like a lot of Indian investors buy gold. So it's more of a store of value than it is an income generating property. Real estate is not very levered from an asset owner perspective, right? It's very hard to qualify for a loan in China. Loan rates are high, so usually people buy a lot of properties on cash just because there's so much excess cash. So don't be concerned by real estate the way the West understands real estate investing in China. This is just flawed, right? Chinese people buy it the way they buy gold as a store of value because there's just too much cash. They don't know where to put it. The government's trying to get the cash out of the property market because it's not terribly productive, right? Because it's buying sort of apartments that aren't lived in. And so the government's trying to get money out of that unproductive pursuit and into the stock market. And that's really probably the biggest long-term win, behind the sales for A-shares is that a lot of unproductive capital coming out of bank deposit, coming out of real estate market now into sort of risk-taking for long-term growth. And then we really see that as a big driver of sort of future valuation, multiple expansion.
Interesting. So interesting. Oh, unfortunately, that's about all the time that we have left today. If we didn't get to your questions, don't worry. Someone from Rayliant will personally get back to you after the broadcast. Thank you so much for attending today's webcast. A big special thank you to my guests, Jason, and Phil. As a reminder, the on-demand version of this presentation is going to go live shortly. You'll receive an email notifying you when it's live. Thank you again, and I look forward to seeing you again next time.